Hey, this is Justin with DayTradeTheMarkets.com, and in this video I want to talk about identifying high edge, high expectancy trade entry location, talk about some of the different setups that I teach, give some logic, philosophy, even show a few examples, and just kind of give a taste of some of the trade setups that I like to look at. And just to look at them in general, these first four here, the retracement, the acceptance pullback, the overlap trade, those are kind of the most basic trades. You could do fine just looking at those. But what I typically do is recommend that people learn these first few, the first four or so at the beginning, and then you can add in these trades as you go along that are a little bit more advanced. And by all means, you can bring other trades that you've used, other setups that you've used throughout the years. You can bring this, and what you'll often find is that when you put these in the context of the boxes, the trade setups that you might be using, and when you learn to score it, which we'll talk about in the next video here, it really makes a huge difference on setups that you might already be using as well. So you don't have to use the setups I teach. I'm just kind of giving you a taste of what they might be like if you want to go that route. Now, to start out, let's talk about really the simplest, most common trade, which I call the retracement trade. The idea here is that we have in this case, a buying box. We know that there was some strong or extreme buying that began this box. Therefore, we know that the low of the box should offer us support. So getting in the lower 15-20% of that box offers us really good trade location with low risk. In other words, our stop is going to be a few ticks below the low of the box. Therefore, if we can get in, just above the low of the box, we have very little dollar risk that we're putting at stake, and our opportunity, it's a high edge trade, and our risk reward is very good because we would expect it at least to make it up to the high of the box, and from there, I call it a checkpoint. We can look and see if the market's showing enough strength that we can continue on and look for a bigger move. But at a minimum, we have very minimal risk in here and a lot of room for movement and a very high edge or high probability that it's going to work out. So it's a good trade. Now, in theory, you could take a retracement trade on every single box. That's not what you want to do. We're going to learn, and I'll talk about it in the next video, how to score trades. There are some boxes that we absolutely don't want to take a trade, but when we do get the right situation, the retracement trade's a very basic, very quality trade. And here's just kind of an example of real chart here where, again, buying box comes in. When it forms, we know that the low of the box should hold. This is a pretty good spot to be looking to be a buyer because, again, our risk is very small and our opportunity is pretty strong, that it should at least make it to the high of the box, and if the market's strong, it could even continue on and give us a better move. Here's another example, again, just looking at it from the short side, where we have a selling box, and we know that if we have a selling box that forms, the upper part of the top of the selling box should offer us some resistance. We call that the line of the sand. So getting in the lower, the upper 15 to 20% is going to give us a low risk, high probability, high reward type of a setup, because again, our stop's going to be a few ticks above the high of that box. It's not much dollar risk that we have to put at stake. It's a high probability that it works out, and it should make its way down toward the low of the box. And who knows, perhaps even beyond that, depending on what the structure gives us. Here's an example here. We're getting in toward the high of the box, should make it down to the low of the box, and we'll see what happens beyond that. So again, the retracement trade, just a very basic trade, one of the first that you'll learn. Now, one adjustment that you can use is what I call the more aggressive retracement trade here. And this simply means there are certain situations or certain scores. Again, we'll talk about that. I'm just kind of touching on it right now. But there are certain situations where the opportunity is so great. For example, the big picture bias might be up and buyers are in total control of the market and everything's looking really great for a long setup. It's a situation where you don't necessarily want to wait for a full retracement all the way down to the low of the box. You want to be a little bit more aggressive and get in around the halfway point. And certainly the risk is a little bit greater if you want to do it that way. But the idea here is that the structure of the market, the score, if you will, is so strong that the extra risk is justified. We have a situation where, in essence, there's almost greater risk in waiting for a retracement all the way down to the low of the box because there's a pretty high probability we're going to miss out on this market. It really wants to take off in certain cases. And here's another example of a selling box. And instead of waiting for a retracement all the way back up to the high of the box, the score in certain cases dictates that it makes sense, if you are a little bit more aggressive, to just jump in a little bit earlier. So rather than waiting for a retracement all the way up here, we want to just jump in right in this area here, yes, we have a little bit more risk, but the score or the situation, the context of the market in this case dictates that that extra risk is certainly worth it because we've got a really high probability situation. So that was the more aggressive retracement trade. Here's another offshoot, another simple trade that we'll call the acceptance pullback trade. And the idea here is that, again, we have a box. Whether you were looking for a retracement trade or an aggressive retracement trade, whether you took that or not, the bottom line is the market was able to, the buyers were strong enough to actually pierce the high of the buying box, got comfortable, formed what we call acceptance up here. So therefore, the high of the box, which was once potentially resistance, now flips over and becomes expected support. So when it retraces back down to the high of the box, getting in right there for a long trade is again a very high probability low risk trade because our stop's going to be a few ticks below the low. So our dollar risk that we have to put at stake is very minimal relative to the opportunity that exists to get long. So again, here is a buying box. We accept above it, pull back to the high of the box. Pretty good spot to be getting on board for an opportunity to get long. Here's an example of this same idea, just on the short side where we have a selling box. We accept price below it. Therefore, what was once potentially support flips over and becomes resistance. We don't have to risk much. Our stop would be up in here. Not a lot of dollar risk at stake. Pretty high probability, pretty high reward possibility there on that acceptance pullback trade. So again, here's a selling box. We accept below it, pull back to the low of the box for the acceptance pullback trade, and then take it short like that. So that was the first one was the retracement trade. The second one was the acceptance pullback trade. This one is kind of a 2-for-1 or the best of both worlds. I call this the combo trade or the overlap trade. And this is a very good trade. I love this trade. The idea is that if you think about the first box here, this buying box right here, if you think about that, we've gotten acceptance above that and we're looking for an acceptance pullback on that first box. Okay, now on the second box here, we've got, and this is our second box, we're just looking for a retracement trade. But again, you can see that the acceptance pullback trade entry would be about right in there, off of the first box. The retracement trade off of the second box would be about right in here. We can just kind of overlap them or look at the area where these boxes overlap, and we know that that's actually a little bit stronger of an area of support, and again, a very low risk, because again, our stop would be somewhere down in here. Very low risk in terms of the amount we'd have to put at stake. Very high probability type situation that the market should continue higher. Now, obviously, it doesn't work every single time, but what's nice about these overlap trades is that if for some reason this one doesn't hold and it fails, that's a pretty good sign that the buyers have run out of steam or that the sellers are coming in with pretty good strength, because that really should have held. The fact that it didn't is telling us this market's likely in for a shift. Here's an example. Again, here's the buying box 1. Here's buying box 2. The combination area here where they overlap is a really good spot to be a buyer. Call this the combo or the overlap trade again. So hopefully that makes sense. Here's another example, and this is a little bit more aggressive, but an example of a trade that, especially in certain conditions when the score is right, rather than waiting for acceptance and then a pullback for the acceptance pullback trade, what you can do if you're a little bit more aggressive, or even if you want to wait for some like level 3 extreme aggression to come into the market, is just buy it. You can, there's a few different ways that we can look at the breakout trade, but instead of again waiting for the acceptance and the pullback, just buy it on the break with the expectation it's going to move higher. Now again, you'd only use this in certain situations, and we'll talk about that in the course, but and in the live sessions. But certainly a very good trade if you're a little bit aggressive. Same thing here on the short side. Again, instead of waiting for the acceptance and then the pullback to the low of the box, in other words, the acceptance and then the pullback to go like that, this would be a situation where we just want to sell the breakout. And again, there's only specific situations you would want to do that, and there's a few different variations of the trade. But the idea is that we're just going to look for that breakout. We expect the market to go vertical, so we can just get in an aggressive fashion. Now, again, I'm not going to talk a lot about the advanced trades, but I just want to kind of point out that so much goes into the scoring system and making sense of the market that just because in certain cases maybe we get a selling box doesn't mean we automatically want to be a seller. We might have a situation where the market evidence is telling us that we want to be long. So even if we have a selling box, for example, instead of looking for a retracement back to the high of the box for a retracement trade short, instead of that, we might want to be looking for a way to get long. So when the box forms, if it comes and retests the low of a selling box, we can actually kind of go against the grain and fade this trade, go with it that way, especially if we get a rejection, because again, it's the same logic. We know that this area here is an important decision point, especially if other evidence aligns. We know that our stop can be just a few ticks below the low of the box, so we have a very low amount of risk, relatively speaking, for a pretty high opportunity type of a situation. Again, in certain cases that we will talk about. So, here's an example of a selling box. Rather than waiting for a retracement and then a pullback, we're thinking, hey, we want to be long in this particular situation. So if this market comes back down and comes back down and gives us a nice rejection, this could be an opportunity for a fade trade to kind of go against the grain. So again, I'm not going to talk a lot about some of these advanced trades. I point this out because there's a lot of different possibilities with this. It's all about using these boxes to frame the market, the scoring system that we'll talk about, to make sense of when it's wise to get into a trade and when it's not, and just some of these trade setups I think very help people understand and help me understand when it might make sense to get into the market. So another real quick thing here that I think is really important, kind of leads to the next point, is that good traders are think about trading almost like a tiger thinks about eating, not like a human. Humans were kind of taught to eat 3 meals a day and a couple snacks or whatever the case may be, and it's just kind of steady and we're eating all day long. A tiger is not like that. They are willing to just stand pat, lay low, conserve energy when there's not a lot of opportunity, and really wait for a great opportunity or an easy meal. And when they get that, they pounce and they have a big meal. A tiger that chases everything it sees all day long is going to get worn out and is not going to have a meal, right? And it's the same thing in trading. If you're chasing the market all day long, it's not going to go well typically. I mean, sometimes you can get lucky, but generally speaking, if you're just chasing the market all day long, it's going to leave you exhausted and your account is likely going to be down for the day. But if we can learn to just stand pat and wait for the really quality opportunity, that's the idea, just like a tiger when they eat. And that leads to the next video that I'll talk about, which is this idea of scoring trades, where we have these we've identified these trades, but we absolutely don't want to take every single one. We want to ask ourselves, and the scoring system helps you do that, and I'll talk about that in the next video, but we want to ask ourselves, do we even want to take the trade, okay? Or are we better off just waiting for and being patient, waiting for a better one later? If we do want to take it, do we want to be more aggressive or less aggressive on entry? Once we're in the trade, how do we want to manage it? And this scoring system that we'll talk about really does a very good job of helping you frame and make those decisions throughout the day. And we talk about those in our live sessions as well. But that's the idea. We identified the trades, which is what I've talked about in this video. Then we score them, which is what I'll talk about in the next video. You put those two ideas together, and you've got a pretty sound methodology for entering and exiting the market with good effectiveness. So again, I realize that was a quick little overview, just kind of a taste, but hopefully it made sense, or at least you got the gist of how it all works. If you have any other questions, please don't hesitate. Just send an email or give a call, and we will talk soon. Look forward to hearing from you. Thanks a lot.